Well, hello, everybody, and welcome to Angie's podcast at the end of every month. I have to tell you, technology is a wonderful thing. However, my guest speaker for this podcast has not quite joined. I don't know if there was a bad link or whatnot, but since I'm seeing some other folks out here on my podcast, I'm going to send him a new one and see if he can't pop in on that. But wanted to let you know, and that's okay because you know me, I can talk about long-term care insurance with or without a guest joining me, and it couldn't be more relevant today with what we're going to be talking about. And that just might be me, myself, and I. But what we're talking about, I was going to have Larry Moore with National Guardian Life join me on this podcast because what we're going to talk about, and it couldn't have been at a better time, with some new um, enhancements, if you will. And I didn't really ever want to make the podcasts about a product specific, but we kind of wanted to come into this one and do a little bit more of a deep dive, if you will, into traditional long-term care insurance, just a high level overview of the product. The reason why this one's really relevant is because you've seen an email from me, you've seen some other information that's come out from me about some recent updates with National Guardian Life's product, and they're really, really relevant changes that are coming down the line. And I want you to kind of hold this to, a lot of folks talk about how the long-term care industry is just dead. It's dead, it's not relevant, nobody's buying this stuff. We see the reports that come from LIMRA. There's lots of talk that goes on out there. If you're out on LinkedIn, you're seeing just kind of the constant back and forth. Is it the hybrid? Is it the traditional? What's going on in the sales? And I think some of the enhancements, some of the changes that National Guardian Life has made to their product should reinforce for you that the long-term care insurance industry is definitely not dead. More and more people, and I almost hate the fact that COVID has really brought this to the forefront of people's minds. But what's interesting about this is sorry, Larry just sent me a text. We're obviously having some technical difficulties, and he's not able to join, but that's okay. I don't want to waste my airtime with you in talking about this. Some of the things that I'm seeing with the COVID, what really brought it forward, and all of you saw it, it was on the national news, right? The debacle they had in the state of New York with all the nursing homes, and I actually had, and you've heard me say this before, I had a gal who's got her husband on claim um, south of my hometown, and she actually pulled him out of the nursing home due to COVID, and because of the long-term care policy, was able to provide care in her home for her husband until they could make sure that the nursing home was a safer place. So some of the changes that we're seeing come down with this, first, I want to mention that National Guardian Life actually just sent out a release that they've been upgraded. Their rating has gone from an A- to an A rating. So that's a strong position in the industry for everybody to take note of, that we're actually seeing upgrades going on with some of these carriers. And on April 1st, which, believe it or not, we are rounding out the first quarter of 2021. And I hope all of you are finding some normalcy. I hope you're finding that consumers and your clients, your prospects, they're ready to get back out. Obviously everybody wants to get back on with their lives, but they're ready to have conversations about extended care planning. I know it's come up a lot more. I can tell by my activity level. I've probably thrown an awful lot of stuff at you here lately with a couple of new carriers that I've brought on, that I've introduced, that I think have some validity in the extended care planning space. I have also let me take a look. Oh, some of you are awful funny. Um, we've got a couple new products. You're seeing all kinds of information coming from me in trying to keep everything relevant and allow you to stay in front of and have conversations with your consumers. And April 1st, just right around the corner, no pun intended. National Guardian Life did not launch this on April 1st to be an April Fool's Day joke. This is very real, and there's a good number of states, definitely all the states that are around Kansas, that are launching these enhancements. And I want to bring them out to you as to kind of what's really important and what are some of these key features that are going on. And what I'm seeing is one of the main things is right. So the National Guardian Life product is definitely a joint policy. So two people, one policy number. That means that there's always going to be a joint waiver of premium. When one person goes on claim, the other person has no premium due. You're going to see this new contract is actually going to have, and it was confusing to some of you, there was only just one premium that was listed. And it was, we always had to explain to you that the way they price their contract is they take the older issue age, and they go by nearest age. So they take the oldest issue age, rate that as a female, because women live longer, right? So we cost more when it comes to long-term care insurance. And that was the rate for both of them. There is now going to be a joint policy with two premiums listed. Now that's relevant because normally when one person passed away under the old contract, the premium stayed the same. There was not a change in premium. Well, now there's going to be that. So if we have somebody that passes away under this contract, the premium will now actually decrease to that surviving spouse's policy. So there's a per person premium now. And so upon death, there will actually be a reduction in premium. That's a benefit enhancement that they have out there. Another thing now, and I know none of you probably even recognize this, you may have questioned it when you saw the illustration, but there is now the contract only waived premium for the base policy. So facility only. And there was going to be, you had to add a rider to waive premium for home health care. I always automatically added that. It was a very low cost rider, like 2%. I always added it because we were accustomed to having waiver of premium for everything. I didn't want anybody to have that oops or hiccup when your client went on claim for home care and then said all of a sudden, what in the world? Why am I still paying premium when I'm on claim at home? So now that's built in. All premiums are going to be waived no matter what level of care once you've satisfied that elimination. One other thing that you're going to see that's kind of different, and this is definitely different when it comes to traditional long-term care. They're going to have one rate class. So you're not what they have today, and for one more day, they have three rate classes: Preferred Plus, which is their best; Preferred, which is everybody else's middle of the road; and then they've got Standard, which is obviously lower than what everybody else would deem to be standard, but it's certainly not a substandard risk. One rate class going forward, and that rate class is going to be called Premier. So that's going to take into what they've done, right? Is they've blended tobacco, non-tobacco, Preferred Plus, Preferred, and Standard rates. They've blended them all into one. And now it's just the Premier rate class. Excuse me. So you're going to see that as a little bit of a difference going forward. Probably the biggest change that I hope all of you take into account. I think if all of us could actually go back to everybody that we've sold long-term care insurance to, I think if we could all go back and maybe muscle a little bit harder for that 10 pay, I think we would do that. I hear it every day. I even hear it from agents that have bought coverage on themselves. I should have bought a 10 pay. Why do we say that? We say that because once you no longer make a premium payment to an insurance company, you're not subject to future rate increases. That's regardless if you're on waiver of premium or if you have a paid up contract. So the beauty of a 10 pay was you make 10 premium payments over 10 years, whether that's monthly, annual, quarterly, semi-annual, doesn't matter. But once you make 10 years worth of premium payments and you no longer write a premium check to that insurance company, they can't raise your rates. The way it has always stood in the industry is that 10 pay was guaranteed renewable, which means they can't cancel your coverage if you make your premium payments, but you can participate in rate increases during that 10 years. Now, what they've done is they've given you a completely non-cancelable 10 pay policy. That means everybody says to me, Angie, if I have this 10 pay premium, will my premiums ever increase? To as of April 1st, the answer is no. These premiums can never increase. Not during that 10 years. That was not always the case. It was, yes, if they take a rate increase in that 10 years, then you'll participate in it. That is not the case now. Now it's a fully guaranteed 10 pay. And so instinctively, with a couple of these changes that I've mentioned, actually those 4 changes that I've mentioned to you, what we need to understand is that I don't know if I've ever, in the 20 plus years I've been doing this, I don't think I've ever had anybody come in, any insurance company come in, even a life insurance company come in and say, we've taken adjustment on our premiums and the rates are going to come down. I think that only happens in the interest rate environment of an annuity. So we don't ever have premiums that go down. So what I want you to know is that albeit these changes are fantastic, you are instinctively going to see new business premiums, not in-force policies, but new business premiums as of April 1st under the new NGL contract enhancements. Premiums are going to look more expensive, not astronomical. And if you've had any illustrations from me here lately, comparing your 3 traditional carriers side by side, National Guardian is winning that, right? They're doing a fantastic job with their premiums. Even with the new business rate changes that are happening instinctively because of the enhancements to the contracts, even though the premiums go up, it's all over the board, but I roughly say about a 35% increase. They are still highly competitively priced against your other traditional long-term care companies that are out there. So don't let that shy you away from wanting to see the National Guardian Life illustrations. Some of the other things that they're changing, really, they've streamlined out some of their rider selections. This won't be really impactful because, quite frankly, these next four items that I'm going to tell you that they are removing, I don't think anybody's going to cry over spilt milk because, quite frankly, they're removing it because nobody sold it. One of them happens to be that step-rated inflation. It's a great idea. Step-rated inflation is a great idea. However, we kind of are creatures of habit. So we are used to, when someone buys a compound inflation rider, we just know they're going to pay a premium for that. And we know the policy is going to increase every anniversary at a compounded interest rate, whether it's 3%, 5%, 4%, whatever the policy allows. National Guardian Life allows a 3 and a 5% step rated. But what step rated means is, obviously, if you visualize steps, right? They step up. And so what happens is you start at a lower premium, and every year the premium increases as well as the benefits increase. So you're stepping the premium as you step the benefits going up. And of course, you can freeze and unfreeze, and you've got a certain amount of times that you can do that before they start free locking you out to where you can't take them anymore. So they're doing away with step rated inflation. Not a real big surprise. We have other carriers that actually have step rated inflation, and it's just not quoted often. It's not sold. There's typically a crossover point, right? So if you buy it at a younger age, in your early 50s, that benefit can go and step up and increase premium, increase benefits anywhere from 11 to 15 years before there's that crossover point where they would actually have paid less premium if they just would have bought the compound inflation without the stepping. So no real big surprise there. Not quoted, not sold, so they're going to remove that from the shelf. The other thing they're removing is the full return of premium. So full return means upon death, regardless of claims paid out, we're going to give you back all the premium you paid in. That is being pulled off the shelf as well. What they do still have, however, is the limited return of premium. And a limited return says, we'll return your premium minus any claims that we've paid out. So there is an opportunity there that if you actually have more claims paid out than you paid in premium, then there is no return of premium to your beneficiary upon death. And that's a very viable thing. It does not take, if you've ever done the claim payback, it does not take a long time on claim for a long-term care event for you to actually get back in benefits what you paid in premium. Um, if you've ever looked at an illustration real thoroughly and looked at the full illustration, it's a really good sales tool because it kind of goes through and closes a lot of the objections. This happens to be one of them, the claim payback, because it tells you based on cost of care, how long do you have to be on claim before you'll actually get back more in benefit than you paid in premium. That doesn't take a long time. I've seen it take as short as 3, 4, 5 months. I've seen it go out as 9 months. I don't ever see it usually going more than 1 year. Obviously, if you're on claim for more than 1 year, you're going to get back what you paid in premium. Excuse me, I got a frog in my throat here. They've also got, I don't know if you noticed this, but they have several return of premium options, and they've got the one that's called the cash surrender, the policy surrender rider option. That basically says is if you keep that policy, so they have a full return of premium, limited return of premium, full and limited with the policy surrender rider on there. So basically they're getting rid of all of the full return of premium riders, even the one including the policy surrender. The policy surrender, really what it was designed for was to try to give you a way to compare a traditional long-term care contract to a hybrid policy. So the policy surrender option said, look, if you keep your policy in force for at least 4 years and you decide to walk away, we'll give you back 80% of your money. So that was kind of their cash surrender option, if you will. So, the whole idea behind the hybrids is whether you live and need long-term care, die too soon and receive the death benefit, or you want to quit and take the cash surrender. That's what they were trying to accomplish here with the full return, with and without the policy surrender value. So just know that the full return of premium rider options are gone. They're off the table, but you do still have the limited return of premium with and without the optional policy surrender rider on there. So still some really great enhancements. The last thing that they're removing is the 0-day elimination period. So not a lot of people buy 0-day. Quite frankly, most people quote a 90-day elimination. But they do still have a 30, 90, and 180-day elimination. They do not have a 60-day. They never did have a 60-day, and the 0-day elimination is being pulled away. So wanted to kind of this podcast was definitely a little bit different. I do apologize that Larry wasn't able to join. Him and I will probably circle back around and try to figure out what we did wrong. Quite frankly, it was probably on my end, not on his end. You know how that goes. But nonetheless, I wanted to hop out here real quick, and kind of give you some updates. It was very timely that we talk about these changes with National Guardian Life because they're very relevant, and I'm super excited about that 10 pay. I know not a lot of us quote that. I think a lot of us don't ever want to get into the conversation or validate, if you will, to our consumers, our prospects, that hey, long-term care insurance is really expensive. You know what? I don't argue that anymore. Is it expensive? Sure, it's expensive. But is cost of care more expensive? Hands down, yes. So just having the conversation, I have to tell you, I don't think my story is ever going to change in the fact that we just have to be comfortable making people uncomfortable. You have to disturb that need. And that's not just for long-term care planning. That's really for any insurance need, right? We sell something that people need, not something that they want. And it's so much easier for us as humans to talk about, to buy, to plan for things that we want versus things that we need. So I don't think long-term care insurance is ever going to become an easier conversation. Right now, do we have a little bit of that? Sure, because the pandemic's bringing forth the fact that you should isolate and, stay lonely and stay away from people, which means if you need care, then obviously you need to do that on your terms. And the way that you do that on your terms is to make sure that you have an income stream that will pay for your care. That income stream is nothing more than a long-term care insurance policy. Nothing more complicated than that. And that's when I'm talking to consumers, that's what I say to them. Don't get bogged down with the idea that you think you're buying a nursing home policy because that's the only place it's going to pay for you to go. It's truly an income stream for you to pay for care that provides care for you and protects your family from all of the stuff that they have to go through when they've got the concierge services at the insurance company level. So, with that, this was a little bit of a shorter one. I want to thank you so much for joining me on my podcast. It will be recorded. It will go up into my video center. You can catch the recording later on our website at producersxl.com. If you have any feedback, any comment that you would love to give me, my email address, Angie@producersxl.com. Phone number, of course, 1-800-541-6705. If you want to hit me up for some quotes under the new software, that's going to happen on April 1st. Make sure that you shoot me an email, give me a phone call. Let's have a conversation. Yes, great. I do have a great question. Will the access to the quote be on the Buddy spreadsheet from National Guardian Life? The answer to that is yes. It should actually be available with the new rates. So thank you for that comment there. Again, thank you all for joining me on this month's podcast. I look forward to next month's, where we'll be talking about something a little different and other sales ideas on that around extended care planning. Thank you, and you all have a great day.